All right, we'll get started now. My name is Carolyn. I am with Midwest Manufacturers Association, and I am happy to welcome you to our manufacturing industry webinar. Today we have presenters Jeremy Johnson from Frandsen Bank and Trust and Terry Stein from Midwest Business Finance Corporation, and they're going to be speaking with us about SBA lending programs. So before I turn it over to them, though, I would like to thank our sponsor for today, Prime Capital. I think we'll go ahead and get started, Jeremy and Terry. If you're ready, I will turn it over to you.
Sounds good. Thank you, Carolyn, and thanks everybody for attending. Just a little housekeeping thing. If you've got any questions along the way, both Terry and I are happy to keep it fairly informal that way. If you've got a little scenario or a question that pops up along the way, feel free to chime in and just let us know you've got a question. If you prefer, you can just drop a chat in the chat box, and we'll try and keep an eye on that. Carolyn will be on the call to kind of help us keep an eye on the chat. So with that, we'll jump in. Just want to make sure everybody can see my my PowerPoint screen here. It should just say Frandsen Bank and Trust. So I'm going to move on from there. Just a quick, not an advertisement at all, really. Just want to let you know who we are as a bank, basically to kind of let you know, essentially, we know what we're talking about when it comes to SBA loan. We're a preferred lender through the Small Business Administration, have been for many, many years. This year, well, we'll get to that in a second here. We're about a $3.5 billion community bank here in Minnesota, North Dakota, Wisconsin, and we've got 38 locations in that geography. My role is market president here in the Foley office, and I spend my days working on commercial financing as well as SBA lending. And so that makes us one of the largest Minnesota chartered banks, owned by Dennis Frandsen. And so we've been around for quite a few years and plan to continue that tradition of being community focused and just steady growth. Take a very advisory approach to banking, and that's really what led us partially into the SBA lending landscape, to be able to add that piece to our banking. And in terms of size, we have plenty of horsepower to do any of the projects that we're going to talk about here today. All upwards of $20 million is a pretty feasible lending limit for us. So there's our footprint. You can kind of see the map. We cover the whole state, and then just a little distribution on where our dollars are. About $1 billion in commercial loans, $1 billion in residential, and $250,000 in farm loans and such. So that's just a little bit about Frandsen Bank and Trust. My role today is really to speak on the SBA 7A lending program. Terry's going to cover the 504 program. They're very, very different programs. As you may be aware, I'm not sure where all of the participants' backgrounds lie, whether you've worked with the programs in the past or not. And so we'll kind of keep our comments fairly high level, but like I said, if there's something that you'd like to know more about, please chime in. If there's a question that we don't know, we will take it offline and we'll make sure we get you the details on that along the way. But so the 7A loan program is kind of SBA's broad lending program. It's a program that they administer through community banks, and so it means that the borrowers generally come to the bank looking for financing, and we maybe find out that there's some hurdles that don't place them into conventional financing quite as easily as they might hope. And so whether that hurdle is, I don't have quite as much down payment as what would be required on a conventional loan, whether that hurdle is I need more time to make repayment than would be traditionally available on a commercial loan, or whether there's some other oddity or uniqueness to the project. So what we often see is that it gets utilized for expansions where there's some unknown in the future. It gets used for business acquisitions a lot because in that world, there's generally not enough collateral because you're also buying the goodwill and the intangible blue sky, if you will, of the business. And so that becomes a little bit harder to finance conventionally just because of the lack of collateral. The other area that we often see this program used in is startups. And so those are kind of high level, the scenarios that they get used in. The max loan amount for an SBA 7A loan is $5 million. So if a borrower needs more than $5 million to complete the project, the SBA portion of it's going to cap out at $5 million. Now, if they have existing SBA loans, we're going to have to factor that in to the calculation. So it's always best to bring that information forward on the front end. But 5 million is the max. It's a guarantee program is what it is. So the bank is doing the loan and obtaining a guarantee from the Small Business Administration. On that terrible day, if things were to completely fall apart and the loan had to go into liquidation, the bank is still going to continue to be the lender. They're going to liquidate the assets and collect as best as they're able to. And then once everything's all buttoned up, let's say there's a $100,000 deficiency that has not been paid. At that point, then the SBA is going to step in and cover their percentage of that deficiency, and that's really the enhancement that they're bringing to the table is providing a place to give the bank some assurance if things were to really not work out the way they were supposed to. And we never hope that happens. And we also don't want to just do loans because there's a guarantee there. That doesn't do anybody any favors to put them into loans that really don't make any sense. So the loans definitely still need to make sense. There's a little chart here, which I don't need to go on the fees that SBA charges. I don't need to go through those in detail. Carolyn's going to send out the slide decks and the recording after the fact if you need them for reference. But essentially, SBA charges a sliding scale based on the dollar amount and the guarantee. So $150,000 SBA loan is going to be 2% fee of the guaranteed amount. So you actually have to do a little math there because you're not going to pay 2% on 150,000. You're only going to pay 2% on 75% of 150,000, and then they go up from there. It can be relatively expensive to complete a $5 million SBA 7A loan because that's going to be 3.5% of that guarantee portion, and that is a significant consideration when looking at something like that. But there are also many times where it is the financing that makes sense. So we just have to take them case by case basis that way. I should reiterate too that those fees do not go to the bank that is providing the loan. Those fees are paid to SBA, and that's part of what helps fund the program. And they do modify them periodically, but in general, they've stayed in this basic range over the years. Every once in a while, they do a waiver if they're kind of promoting things and trying to get things done. We're just coming off of that in the last few years, but that's where those are at. So here's a quick list of things that the program can be used for. Like I said, 7A is the most wide, has the most broad opportunity. So you can finance land and building. Although if you come to me looking for a 7A loan to finance land and building, I'm probably going to introduce you to a guy like Terry, because generally speaking, that's going to be a better fit. Case by case basis all the time. Expansions and renovations are a good use of it. Equipment and fixtures. Fixtures are sometimes hard to finance because you can't always get as clean of a collateral position on a fixture, depending on what the who owns the real estate and things like that. So that's can be a use of it. Working capital to fund growth is an area that it definitely gets used for. When you're looking at growth, it's expensive and you need working capital to fund it. But if you don't have that history of being able to pay for it, SBA can help us get over that hurdle with a decent business plan and projection to show how that trajectory should work out. Same thing with inventory. That really fits into the working capital, the same concept there. If you need inventory to grow your business, it's expensive, and SBA can help finance that. Now, if a business finds themselves in a position where they've gotten different financing from all over the place and cash flow is a challenge, but they have good equity in their equipment, maybe a consolidation or a refinance is a good scenario. SBA can help with that, especially if historical cash flow maybe isn't as strong as it needs to be conventionally, but there's a plan to look forward and make that work. And then lastly, probably the one that I utilize the program the most for in my office is for business acquisitions. Like we talked about before, having enough collateral on a business acquisition is often a challenge. And so SBA can step in and assist with that. Because and the reason all of these things can be worked into the program with SBA is just because there's a collateral shortfall, that's not an automatic turn down from SBA 7A. They can work with collateral shortfalls, assuming the cash flow makes sense and the borrowers are eligible, obviously, and then that management has a good handle on how to make the business cash flow that way. So wanted to touch, there's been if you're familiar with SBA loans and you want to get into the nitty gritty, I do want to make a point to remind folks that in June of 2025, they did make some changes to the program. And really what they did is kind of reverted back to some previous guidelines. And so they changed some of the equity injection requirements when it comes to financing projects that have seller financing. It used to be a little easier to utilize some seller financing for a project. And they also made some changes to how they handle partial ownership changes and the guarantees that need to accompany that. They also put a hard and fast rule in there about citizenship, that all owners of a business need to be citizens. And then they made some changes to the franchise. If anybody deals with franchises, like fast food restaurants or really any kind of franchise, they need to be vetted by SBA and approved to make sure that SBA is cool with the way the franchise operates. That one's up in the air a little bit right now. They still have some work to do on that. We expect it'll work itself out over time, but they still need to give us a little guidance there. And the franchises themselves need to do some work. So, but that's kind of a niche thing. So I want to also, there's some subcategories within the SBA 7A marketplace. So there's 7A loans, which are generally going to be term loans. And the term of the loan is going to be dependent on what the collateral useful life is. So if you've got equipment that's got a 10-year useful life, we can generally look at doing a 10-year loan on that equipment. If you've got things that are can go out longer than that, we can stretch that out. If there's real estate involved, that starts to give us more flexibility on the amortization. Case-by-case basis, I don't really want to bore you with the calculation and how we would get to that, but really it hinges on what's the useful life and what's the majority of the collateral. But the subcategories, they've got a program that is specifically just for lines of credit called the SBA Express program. That's for smaller credits. For FYI, that's a 50% guarantee versus the 75 and 85% guarantee that the traditional 7A program carries. And that one's going to be, it's a revolving line of credit, and it's going to be a good opportunity to help with some of those working capital needs and funding accounts receivable, inventory, things like that. But it's going to set it in place for long. Usually it's a 5 to 7 year period that we're setting those in place for, to give time to utilize it, see how it's working, and then if it is not revolving, also give time there to term it out, put it on payments, and get it satisfied. So that one is very common to be put in conjunction with, say, an expansion loan, a term loan to do some equipment financing or expansion, and then a working capital loan to fund the operating side of it. There's another program that's not utilized a lot, but I do want to at least make sure people are aware of it. It's called their CAP Lines program. It's for large operating lines of credit up to $5 million. This one, it's pretty unique. And so if you have somebody that, or if you yourself need to use it, it's best to just kind of reach out and start understanding the program. It does not get used very frequently, but I will say this: it can be a good stepping stone back into conventional financing if a manufacturer or another business finds themselves in an accounts receivable financing arrangement or a factoring agreement. This is kind of a good gradual step back into conventional line of credit for those types of things. So basically, if a business has found themselves in needing accounts receivable financing or factoring financing, that's a pretty expensive way to go, but often is needed. And so for growth or whatever the case may be, but if they then are kind of graduating into heading back into conventional financing, this can be a good setup for that. So just to know that that's out there. This slide here is just kind of a quick little example. I think the key here is to remember that the equity, so 10% is the minimum equity requirement. That in our world, that can be a cash equity injection, or that can be equipment equity, or other. It can be other kinds of equity. It doesn't have to be cash. But it's also important to remember that the funding for working capital adds to the total project. So in this scenario here, you see we've got $200,000 of equipment being purchased, but they also need $100,000 of term working capital they also need $100,000 of working capital total needed, and then they also have to do $50,000 in leasehold improvements. So that's a $350,000 project. So then the way this one is structured, we're going to put $250 on the term loan, the 7A, and then the next line down, I should put my mouse on there, and then the express line is going to be 50. So in this scenario, we must be assuming that some of their working capital is going to be long-term, and we need to term that out right off the bat. But about 50,000 of it here must be planned to be short-term, and so we're going to put that on a revolving line of credit that can hopefully ebb and flow as cash flow allows. And then the borrowers are going to come to the table with $50,000. Well, technically in this scenario, the borrower could come to the table with as little as $35,000, because SBA's requirement is going to be 10% down payment on the total project. So the total project is $350,000, and so the equity is going to get determined off of that. Now, just because that's SBA's minimum doesn't mean that's what makes sense for every project, but that's the minimum. That's kind of a sample, and I think the reason this one was a little bit higher than 10% is because it was a startup scenario, and so sometimes it's important to just make sure that there's adequate equity going in on the front end. Couple other eligibility requirements that I want to touch on, and these often cross over with Terry's world, but obviously we need to have people of good character, and then we're going to do, SBA is going to require due diligence on that, to make sure they don't have outstanding tax liens or collections issues or credit issues, things like that. That's a little bit of a subjective category, but we do need to work through the checklist on that. They are going to ask about, SBA is always going to ask about felony convictions if they've had those, and it doesn't necessarily kick someone out of being able to get an SBA loan, but there's going to be some more questions to answer regarding that. As the further away in time that situation occurred, the better. But again, like everything, case by case scenario. SBA does maintain the 51% occupancy requirement in general. We need to, if we're dealing with real estate, we have to have the operating business be the primary occupant. SBA is not designed for investment situations. It's designed for operating businesses to access capital. In almost every category, almost every situation, we're going to need a feasible business plan. And that doesn't necessarily mean that we need to have a 120-page dissertation, but we do need to cover the nuts and bolts of how this business is going to function. We need to understand, and the next line also reiterates that, management expertise. What's the resume of the individuals who are going to be running this business, and what experience do they have to demonstrate that they know how this works? We need to understand who's going to be working at the business and what roles they're going to be playing. Are there additional key employees that are going to function within the business? What's your competition? What's the industry that you're going into, and some of the detail behind that? Essentially, what homework have you done to make sure that this business is functional? The caveat there is, if it's a long-standing business with existing management, we can generally get by much thinner in the business plan space. But usually, if you're going the SBA route, there's something about the project that's going to require a story to tell as to looking forward, and that's really what we're looking for in the business plan. We always need to have adequate equity invested in the business. SBA defines the minimum adequacy at 10%. Like I said, that can be cash or other assets on the 7A side, and but that may mean appraisals to determine value and such like that. We always have to show that the plan is that the cash flow will support the debt. We can't put anybody into a situation where the cash flow does not. And then sufficiency of collateral. I know the slide says sufficient collateral. SBA defines sufficient collateral as to the ability of the business and the company. So what that means is there can be a collateral shortfall, but if there's a collateral shortfall, that means that both the business and the guarantors have pledged the collateral that they have available. And normally what that ends up meaning in the SBA world is all the business assets have been pledged as available, and then if the borrowers have personal real estate, or if they have highly liquid investments, those types of things would probably need to be pledged in some fashion to help offset any collateral shortfalls. Now, if they don't have any of those things, that kind of puts them in a category of SBA is okay with that as long as they've done as much as they're able to. Now, at a certain point, it does, if it gets way out of whack, way too much project for collateral, then there's a little more underwriting then there's some more subjectivity to the discussion. But that's kind of SBA's general approach to collateral. I didn't mention guarantors. So everybody who owns 20% of the business or more is going to have to be a guarantor. So if they're under 20%, they don't have to, unless maybe, let's say you have a 15% owner who's also the day-to-day manager of the business. That would most likely get looked at as a key employee with ownership, and that gets it's a little bit of a gray area, but they probably need to be involved to a higher level. That's more of an advertising slide. I don't need to hit on that one today. So I did want to hit on a couple of the pros and cons. So the pros of 7A is amortization and how long you can stretch out your project. If you're going to come to most community banks and look for an equipment loan, we're probably going to be in that 5-6 year. New equipment is going to be in that 5-6 year amortization. You need to pay it off in that amount of time. If you're going to go with the 7A loan and can document that this equipment should last 10 years, then we can probably stretch that out to a 10-year and lower that payment. Now, at the end of the day, it's going to be more interest paid, but it's going to help your cash flow. Down payment is going to be lower with SBA, like we talked about. Usually it's that 10% or 0% if you're using other equity within the business. And so that's going to be different than the conventional world. And then obviously that last one we've talked about, the guarantee allows us to get over some underwriting concerns that might otherwise halt the project. So, but there are, it's not all sunshine and rainbows. On the con side it is important to find a lender who knows how these programs work. So, and the only thing I'll say there is just make sure you're working with a preferred SBA lender. If they don't have the preferred badge, that means that they have to go and work directly with SBA on everything, and that can really protract the timelines that it takes and complicate the progress. It usually ends up being back and forth, dealing with a government agency. If you work with your banker who's a preferred SBA lender, that means that SBA has delegated authority to the banks. They know the rules, they follow the rules, they have a history of doing so, and therefore, if they approve the loan, it's approved. They just go out to SBA, get their number, and get their funding. Now, if they didn't follow the rules, that's on the bank, and they're going to have to deal with that down the road. So it's kind of self-policing that way. But it really smooths out and speeds up the process. That lender can talk you through the whole process on the front end very clearly, versus a non-preferred who is often going to miss some of that and really extend out how that's going to work. So the paperwork, all government stuff's going to have paperwork. A preferred lender is going to be able to help you minimize that. Talk about rates a little bit. They're going to be higher than conventional financing. Typically, 7A loans are going to be variable rates. They're going to be in that Wall Street Journal prime +2 to prime +2 3/4. So today that would be what, 9 1/4. So it's kind of risk-based pricing is, I think, what the industry would tell you there. Loan servicing, if you need to make changes to a 7A loan, they do have some rules that follow that. Generally what it means is they need to keep things pretty similar to the way they were. They can't just release collateral without putting payment towards the loan or some things like that. So it can be a little, because they've taken more risk, they need to maintain their collateral position that they started with. So, and then we already talked about the home equity as a junior lien. If there's a collateral shortfall, that's pretty normal. Another thing that's very, very common is making sure that a borrower has life insurance, so to cover the debt, especially when there's a collateral shortfall. So couple resources that I'll throw out there for everybody that often come in conjunction with 7A lending. Midwest Business Finance Corp, that's Terry's group. He'll talk in a second. Obviously, we're on the list. SCORE is a nonprofit group that is retired business professionals and help mentor business owners. They can be a great resource and work really well with the SBA programs. The Small Business Development Center, we've got one right here in St. Cloud that does a great job, and we can connect you with them if you have any questions. They are essentially SBA's consulting wing. They can really help with business plans. They can help with specific questions, and they understand the lending program as well. And then lastly, gap lenders. It's very common to bring in a gap lender to help if a borrower doesn't quite have the some of the equity components, or something is a little bit short to fill in some of the funding gap. That's what they're for generally. And we've got a good list of those individuals that we can help you share those contacts as needed too. So I think, yeah, that's gonna be the end of my slideshow. That took a little more time than I was actually thinking it would. So I'm gonna jump off here and pass everybody over to Terry and let him take it from here.
All right, thank you, Jeremy. Let me get my screen up here. There, hopefully you all can see that.
Yep, we're good.
All right, well, thank you, Jeremy, and thank you, Caroline, for the platform and allowing us to present today. My name is Terry Stein. I work for a company called Midwest Business Finance Corporation, where I'm not an SBA employee. Midwest Business Finance, we go by MBFC, has been around since 1983. In the industry, they call us a certified development company, meaning, as Jeremy stated, the 7A program is meant for guarantees for finance, and that's actually guarantees. The CDCs actually inject dollars in the deal through the 504 program, and that's what we do. I essentially will get the application approved for the bank and the borrower, and do a little hand holding during that closing process, and then eventually we get to a point where we actually fund the SBA loan, and then we service those dollars from cradle to grave. So essentially, we provide small business owners with fixed asset financing through this program to promote economic development. There we go. So this is not meant as an advertisement, but it is important to understand that there's differences between CDCs. Our CDC has been ranked #1 in Minnesota for the last 11 years. This is ranked by the SBA district office, and it's really based on volume. Our mission is to be the premier CDC in the upper Midwest, working in partnership to foster business development and job creation and retention through the access of capital. We lend in all of Minnesota, of course, all of North Dakota, parts of South Dakota, Iowa, and all of Wisconsin. Today we have an application pending to expand all the way into the entire state of South Dakota. So we have a fairly large footprint. Our impact, this is mainly advertising, I'll skip that. We service everything from cradle to grave. Our outstanding as of fiscal year 24 was $465 million. That has increased. We're approaching $500 million today as we finish 25. The 504 program, as I mentioned, provides dollars as opposed to guarantees. And those dollars provide long-term. The rates are below market and they're fixed. And it allows the borrower to get into a fixed asset like commercial real estate, land, building, or long-term machinery equipment on a with less down. The program is meant, as Jeremy mentioned, meant for the owner-occupied borrower. So they're not really interested in lending to like the real estate investment guy. So they do have an occupancy rule in place. And that is the operating company needs to own and operate 51% or more of the building. If it's a new construction, they need to occupy 60% out the gate with a plan to occupy 80% by year 10. Okay. So the benefits of the program: there's really two sets of benefits. One is to the banker that utilizes the program, and the second is to the borrower. The first to the banker is that we mitigate risk to the borrower. SBA will allow the bank to be in a first real estate mortgage position at 50% loan to value. That has value. That's going to allow Jeremy or other lenders out there to lean in on a deal a little bit more, because it's pretty hard to, when you're at 50% loan to value, it's pretty hard to lose money on that type of a scenario. The benefits to the borrower is again, as I mentioned, they allow a borrower to get into a commercial real estate building with less down. Our rates are fixed, fully amortized, no maturity date for 10, 20, or 25 years. And we only finance those the long-term assets. So those short-term assets we're not going to use that as collateral. So we're not going to take like a lien on a house, or a cabin. We're not going to take a lien on inventory or receivables. Those items will remain lien free from SBA, so that the banker can utilize them for like a line of credit or something else out there. The standard structure in the industry, if you're a banker, is 50-40-10. So typically bank finances half, SBA will finance 40, and the borrower needs to bring 10%. Now that borrower contribution, that 10%, there's several factors that can impact that. And essentially what they are is, one, if the property's special purpose, like a hotel or a gas station or an assisted living, SBA will automatically add 5%. Raising that structure from a 50-40-10 to 50-35-15. Now, if the borrower isn't deemed to have experience, they'll add another 5. So realistically, if you have like a startup, like say gas station or startup hotel, you're looking at 20%. So that's why it's kind of important to reach out and bring me in on projects, or bring us in on projects up front, so we can determine this eligibility and determine this loan structure up front, so that you're not getting that too far down the train track and then have to shift gears when eligibility wasn't determined up front. So that's important. What we can finance, what's eligible. Jeremy touched on this, but we can do obviously the land acquisition, the site improvements, the purchase of an existing building, or the construction of a new one. We can also finance the acquisition of long-term machinery and equipment. We can also refinance debt on a limited basis. And we can also finance the professional fees in the project. Our project size today, for most projects, it's $5 million per, as far as SBA dollars. However, on manufacturing today, we can go up to $5.5 million on each project, but that's specific to each project. So essentially, if you have multiple, locations, there really is no limit with certain manufacturing. There is also some rumors coming from the DC with the new administration that this may change from 5 to 10 million. So I guess keep your ears open. If that does, that'll certainly open it up for a lot of different types, for bigger type transactions. Our rates are funded every month. And again, it's really more of kind of like a bond than a loan. So on the 10-year last month for August, they funded at 5.78. On the 20-year was essentially 6%, 6.02, and 25 was at 6. And again, that's fixed, fully amortized, no maturity date. Okay, so there's really 3 products that we provide. One is the traditional product, and I have an example here of one. And this is a manufacturer that wanted to purchase the location that was currently being leased, right? So we have a purchase of the land and building at 3.8 million. We also include the professional fees to put this together. These are fees that they're gonna pay, whether that's bank fees, title, closing, appraisal, those type items. We can include them in the project. So in this case, we had a project of $3.9 million, and we split that 50 with the bank, 40 with SBA, and 10% needs to come from the borrower. Now, that borrower contribution can come in different forms. One is cash. In this example, we had 2% from the borrower, so they were able to get into this, buy this building with only 2% of their own cash. And then they utilized the difference of what was needed through a seller carryback. And that's allowed. The SBA will also allow you to use debt as a form of borrower contribution. Now, there's some rules that we have to go by when we do that, but essentially that is available, and it's utilized regularly. Here's an example for a new construction, and this is a startup now, right? So in the deal like this, it's important that we have projections, and within the projections, we have a business plan that explains the assumptions and talks about how they're going to retain liquidity so that they can operate if those projections aren't hit. But in this scenario, we have the purchase of land. We have the construction costs that we finance. We included a contingency. We also financed the FF&E, and then also professional fees for a total 504 project of $1,420,000. Now, again, that's split 50, in this case, 35-15, because this is a startup, so they add an extra 5%, right? But this is also an example of utilizing a gap lender to help us with the ineligible items. So they also needed some startup inventory and some working capital, about 150,000. Those items are not eligible with 504, but we utilized the Southwest Initiative Foundation, and they were able to fill that gap, and it worked out really well. All right. So we also have one more example here, and this is really interesting for the lenders and the manufacturers out there, that we can do equipment only. So this is a manufacturer equipment purchase where we utilize 3 different gap lenders. It doesn't have to be just simply one. So the project here is and this was a fairly large equipment. So you're looking at a purchase of 9.9 million. We included all the professional fees, which generally, when you have this big equipment, it takes a long time to get it installed and up and running. So there's generally interest expense and all that stuff that we can count. So we ended up with a project of 10,100,000. We split that 50-40-10, right? Of which the borrower's cash was only $60,000 on a $10 million project. And the difference was funded through essentially 3 gap sources, 2 in Morrison County and 1 through the state of Minnesota. And it worked out really well. In this case, because this equipment was long-term, generally in the rule book, SBA requires that equipment only is on a 10-year term. In this case, because we were able to prove out that the useful life of this equipment is 20 years, we were able to get this on a 20-year debenture. The next product is a refi expansion. So basically what we're looking at doing is refinancing existing debt and then funding the expansion. So in this project, we have the purchase of new equipment. Again, it was fairly large items. So you're looking at about almost 11,450,000. We refinanced the existing debt on that equipment and had that equipment appraised. And we're able to utilize that equity in that equipment for borrower contribution. So the splits didn't quite work out to 50-35 or 50-40-10, quite simply because the project's so large, we were capped at $5.5 million for this manufacturer. So we're at the bank's at 56. They funded 8.8. We funded the 5.4, and that 10%, the borrower's contribution, essentially was equity in that existing equipment. So we were able to purchase close to $12 million worth of equipment with no cash out of pocket from the borrower. That worked out really well. And then the last program we have is the refinance program. the refinance program, I think overall nationwide is somewhat underutilized. And it really comes down to bankers essentially paying attention to what's eligible. And what really works really well for this program is like refinancing contract for deeds, or refinancing loans that have balloon payments that are coming due, or even conventional loans. And we have a first example here. This is a manufacturer refinance with cash out, which is allowed. And essentially, we had a manufacturer that had a fairly large need for cash, and I can't remember what exactly it was, but it was close to $1 million. So what we did is we refinanced that existing debt, which was 8.6. We provided cash out of 910,000. Of course, we financed the professional fees, you know, the closing, appraisal, title, all that stuff. But because the equity in the building was so strong, we were able to essentially utilize all of the equity in the building for a total project of $10,600,000. And that loan split was the bank financed half, we financed 40, and that 10% borrower contribution was equity. So we were able to refinance this debt, provide $900,000 in cash out, and it worked out, again, quite well. Our process is pretty straightforward. We operate kind of like a bank, and it's very similar in that essentially, once we establish a project that's eligible, I'm going to essentially give everybody a list of what I need, of which 90% of those items the bank's going to want or will have. And together, Jeremy and I will work our files together to a point where the bank has credit approval. They'll provide me a commitment letter, and then I need about, I don't know, 2-3 days to underwrite it, and then it'll go to our internal loan committee. Once we have our internal loan committee approval, which meets every week, by the way, then we can submit to SBA, and then we're on SBA's clock. Today, prior to the government shutdown, that turn time was about 3-4 days, and then once we get the approvals, we do a little hand holding to get the bank closed on both loans, and then I set it up for the SBA closing on the back end. My contact information is on the board. We have essentially 4 branches, and these are other loan officers out there. So essentially, that's my presentation. Again, I appreciate the opportunity to talk about 504, and if there's any questions, we certainly will entertain them now. So.
Yeah, any questions from anybody before we call it a day? I don't see any in the chat. Well, if someone thinks of something after we get offline, feel free to connect with Terry or I, whether you've got a project or whether you just want some input on a scenario or a structure or some of the rules. We're happy to do some of that research work and just be a resource in that front. I think I speak for both of us when we say that we're happy to do that. So,
Well, thank you, gentlemen.
Carolyn, any housekeeping before we sign off?
Nothing from my end. I just want to let everyone know that we will be sending the recording out to all of those folks that registered. It will also be posted on our YouTube page, and I will also send out your slides. So I think we're good to go.
All right.
Thanks again for your time. Really appreciate it.
Thanks, everybody. We'll see you soon.
Thank you.
All right. Bye-bye.